The budget was a big one for pension changes. The pre-budget speculation around pension changes may have understandably unnerved many of you, but fortunately, a lot of it was just hype. The tax-free lump sum allowance remains at 25%, subject to a maximum amount. On your contributions, tax relief remains at your marginal rate, in addition to the contribution level remaining at a maximum of £60,000. And there was no reintroduction of the lifetime allowance. However, the big change was that from April 2027, pension values will be assessed as part of your estate and will be potentially subject to inheritance tax, whereas previously, in the main, pensions were exempted. From an inheritance tax perspective, this treats pensions like any other asset you own. Fortunately, spousal exemption will apply so that if you nominate your spouse or civil partner to receive your pension, an inheritance tax will not apply. If we actually look at what a pension should be, it's a vehicle to be used to fund retirement. However, since pension freedoms way back in 2015, when the 55% tax upon death of the pension member was removed, they've often been treated as an effective wealth transfer and estate planning vehicle due to this exemption from inheritance tax. The budget announcement to bring pension values within the scope of inheritance tax at a rate of 40% brings us full circle and makes pensions less efficient again for estate planning, essentially moving pensions back to being a retirement vehicle to be used in your lifetime. It must be noted, these announcements impact defined contribution schemes, whereas defined benefit schemes, including most public sector schemes, will be excluded. In addition, most annuities are also excluded. One of the major impacts here is if death occurs after the age of 75 and the pension is left to anyone else other than a spouse or civil partner. In this instance, the pension value could be taxed at a 40% inheritance tax rate, and when the beneficiary starts to draw on the pension, it would be taxed at their marginal income tax rate. This could potentially lead to an effective tax rate of 67% when combining inheritance tax at 40% and the highest rate of income tax at 45%. It's also important to note for UK residents is that international pensions such as CUROP and QNUP pensions have also been brought into the scope of inheritance tax. Firstly, there's time. These changes only start from April 2027, so there is no need to panic and make any immediate changes. We would recommend to anyone with a pension scheme or schemes that you should be speaking with a wealth planner and taking advice from a regulated financial advisor before you make any changes, especially if you've been using your pension under a spend last approach and viewing your pension as an inheritance tax and estate planning vehicle. It may be wise, dependent on your circumstance, to start accessing your pension sooner rather than later, whether via a drawdown strategy or to potentially consider annuities to guarantee an income stream which you can use within your lifetime. Importantly, you may wish to reconsider who you've nominated to receive the death benefits from your pension, as this might need changing, noting the spousal exemption from IHT I just mentioned. For individuals who are looking to gift, it may be beneficial to draw on the pension tax-free lump sum, as well as the taxable portion, and gift the money, utilising the 7-year gifting rule. Or you could potentially gift from your surplus income when drawn from your pension, and if appropriate. It's our firm belief that you would benefit from a wealth plan bespoke to you and your circumstances. A carefully constructed plan would map out your needs and wants and how you can achieve them from your pensions and other assets. It's only once you have your overarching plan that you can start to apply some of the suggestions mentioned to achieve your retirement and estate planning needs. We're here to help you plan for the life you want to live.